Hi everyone, I'm Teng Chong from the iFast Fixed Income team, and in this video, I will be helping you to better understand perpetual bonds. I will first start off by explaining what perpetual bonds are, and in the second half of the video, I'll be touching duration and how it affects your portfolio. So first, let's start off with what is a perpetual bond. So a perpetual bond, or also known as a PERP, is a fixed income security with no maturity date. As the name suggests, the coupon payment of the bond will be paid forever in perpetuity. Therefore, the issuer is not obligated to repay the principal amount of the bond as long as they continue making coupon payments to its bondholders. By accounting standards, perpetual bonds are treated as equity as the issuer bears no requirement to repay the principal. Perpetual bonds are usually ranked subordinated in nature with respect to other securities, and this means that in the event of a company's bankruptcy, perpetual bond holders are paid behind senior securities. In order to compensate the subordinated seniority and uncertain maturity dates of perpetual bonds, companies will issue perpetual bonds at higher yields as compared to plain vanilla bonds. Most but not all perpetual bonds have call features embedded in them, and this allows the issuer to redeem the PERPs at some point in time in the future. Such call features allows the issuer to redeem the bonds in full principal amount at a selected first call date, usually 5 years from its issuance, and subsequent call dates at every coupon payment period thereafter. If not called, the PERPs will usually have a reset feature embedded which allows the perpetual bonds to have a coupon reset at the prevailing interest rate benchmark rates such as the US Treasury or the Singapore overnight rate average, plus the initial credit spread of the bond. One example is the HPL SP 4.4% perpetual bond. The perpetual bond is issued on 22nd October 2019 and has a reset date 5 years later on the 22nd of October 2024. And if not called on 22nd October 2024, the bonds will reset at the prevailing 5-year swap offer rate plus the initial spread of 291.5 basis points. So having a reset date embedded in the bonds may incentivize companies to call back their perpetual bonds during a period of rising interest rates. This is because as interest rates rise, the prevailing benchmark rate may rise as well, and this will push the reset rate to be above their original coupon rate. This increases the cost of borrowing for the issuer as they have to pay more in interest payments to its bondholders, thus making it more economical for the issuer to call back their perpetual bonds to refinance at a cheaper rate. In addition to reset rates, some PERPs may have coupon step-ups that will trigger at some point in time. Usually, the coupon step-ups will coincide with the call dates of the PERPs, and if the issuer does not call back its PERPs on the call date, a coupon step-up may occur in addition to the coupon reset rate. Taking ESR Cayman 5.65% perpetual bonds as reference, it has a call date on the 2nd of March 2026, and if not called, the PERP will reset at the prevailing 5-year swap offer rate plus initial spread of 4.73%, and additionally also a step-up margin of 200 basis points. Thus, a coupon step-up on the call date heavily incentivizes the issuer to call its PERP, as usually the reset rate will be much higher than the original coupon rate. A perpetual bond without a reset rate and a coupon step-up is also known as a fixed for life perpetual. These perpetuals do not offer any change in coupon rates and pay a fixed amount of coupon for life. The issuer may not call back the PERPs at all as they have no incentive in doing so. Furthermore, in a rising rate environment, investors may not receive attractive yields from these bonds. Next, I'll explain the pros and cons of investing in perpetual bonds. For pros, perpetual bonds are suitable for investors who seek indefinite interest payments. Perpetual bonds offer stable interest payments over a long period of time. Perpetual bonds usually offer higher yields as compared to plain vanilla bonds due to their indefinite maturity and subordinated seniority. Some perpetual bonds may have coupon step-up or reset features that could provide a higher coupon rate in times of rising interest rates. Next, for the cons, investors may have their funds locked in the principal amount of perpetual bonds and may not have enough to invest in other opportunities. The subordinated nature of most perpetual bonds also means that in the event of an issuer default, investors may be paid after senior bondholders. Perpetual bonds are also more prone to interest rate risks, which could lead to the bond price being more volatile as compared to plain vanilla bonds. Now that you have a better understanding of perpetual bonds, let's move on to the second part of the video where I will explain more on duration and how duration affects your portfolio. When investing in bonds, it is important to understand interest rate risk and how to manage one's interest rate risk. Bond duration is one way to understand interest rate risk when it comes to investing in bonds. So bonds have an inverse relationship to interest rates. When interest rates rise, the price of a bond will fall, and this happens vice versa. Duration can be used as a measure to determine how much a bond price will fall due to the increase in interest rates. Theoretically, duration is defined as the average time to receive the cash flows from a bond, and it is measured in years. So essentially, it is the amount of time it would take for an investor to recoup his investment. So for a zero coupon bond, since the principal amount will be paid at the bond's maturity, duration for a zero coupon bond will be its time to maturity. For every 1% increase in interest rates, a bond price will decrease by the same amount of years in duration. Therefore, a bond with a duration of 5 years will expect its bond price to fall by 5% for a 1% increase in interest rates. Duration, however, should not be confused with tenor. A tenor of a bond is the remaining time to maturity, while duration measures the sensitivity of a bond's price to changes in interest rates. The table illustrates the effect of duration on a bond's price. For a bond with a duration of 5 years, there will be no change in interest rates. Bond price remains at 100. When there is a 1% increase in interest rates, the bond price will fall by 5%, leading the bond price to be 95. And when there is a 1% decrease in interest rates, bond price will increase by 5%, leading to the bond price to be 105. The factors that affect a bond's duration are: number 1, firstly, coupon rate; number 2, time to maturity; and number 3, yield to maturity. So when a bond has a higher coupon rate, the investor will be able to recoup his or her investment amount earlier, leading to a lower duration. A shorter time to maturity will lead to the principal amount to be redeemed sooner, therefore a shorter duration. And lastly, a bond with a higher yield to maturity shows lower duration. One easy way to gauge a bond's duration would be to see the bond's time to maturity. It should be approximately close, but not more than a bond's time to maturity. As seen from the chart, we compared 3 different Mapletree bonds of different coupons and maturity dates. The performance of the Mapletree 2031 bonds are the worst among the 3, as it has a longer maturity date, which leads to a higher duration. Therefore, its bond prices will be more severely impacted by interest rate changes. The Mapletree 2026 bond has the best overall performance, and its drawdown was the lowest. This was due to a shorter time to maturity as compared to the rest. Duration can be used to understand your portfolio's interest rate risk. When investors expect an increase in interest rates, their portfolio duration should be low as to prevent their overall portfolio from being affected severely by the hike in interest rates. Investors should hunt for bonds with high coupon rates with a shorter time to maturity. And vice versa, when investors expect interest rates to decrease, portfolio duration should be high. Thank you for watching today's episode. I'm Teng Chong from the iFast Fixed Income team, and I hope to see you all again.